As of June 2024, I'm getting on average a 14% dividend yield from my top 5 monthly dividend paying ETFs for income. Hi, I'm Raj, and this month I can pay to see Wolverine and Deadpool with dividends from my portfolio. And maybe you're interested in doing something similar, whether it's fund money, reinvesting, paying bills. There's something we could all do with extra income. And since we're talking about some extremely high yield dividend ETFs, the quick math here is that it would cost $85,714 at a dividend yield of 14% to generate about $1,000 a month in passive dividend income, which is more attainable for most people compared to the high six figures needed with other ETFs like VOO or SCHD. Before we get really going here, I do need your help because I'm not a professional and this isn't financial advice. I have no idea how these funds will perform long term, and I know there's something that I missed or got wrong in the video. These ETFs are incredibly detailed and nuanced, so please correct me in the comment section if you notice something wrong or want to expand on further. I'm a one-man operation, so the more good information we have, the better, and I'm curious to know about your positions as well, so let me know in the comment section. All right, let's get into it. Our first ETF is the very popular JEPI, also known as the JP Morgan Equity Premium Income ETF. And we're talking about this one first because it's the lowest yielding ETF on this list, coming in at 7.68%. So it only goes up from here, but also it has the highest assets under management of all the ETFs on this list, coming in at $33 billion. So it's not the largest ETF based on assets under management I've ever seen, but if you're looking for income or high yield in the form of an ETF, the market votes with its dollars. And 33 billion of those dollars have confidence in JEPI. Its goal is to deliver monthly distributable income and equity market exposure with less volatility, which is ideal because if you're using this ETF for income when you're in retirement or supplementing your income from multiple sources with one of them being JEPI, you want to know that things aren't going to fluctuate a whole lot as the markets move up and down and as time goes on. Does JEPI hold up against the S&P 500? Is it actually less volatile in comparison, and has it been paying out a consistent dividend? Well, according to this chart, the S&P 500 is up 85% and JEPI is up 57% since June 1st of 2020, which is a few days off from JEPI's inception, but it's still close enough for us to see that overall the S&P performed better, but the ETF is focused on income, so that is the trade-off shown here very clearly. But the good news, JEPI did appreciate in value, and we can see that JEPI does generally follow the S&P 500 for the most part. And to be clear, this is a total returns graph, which factors in price and dividends, so there isn't a right or wrong option here. It just depends on what your goals are. If your goal is to generate some income and not have to worry about selling your positions, JEPI or another similar ETF might fit the bill. What about volatility? So just a quick Google search led me to this website where we plug in our ETFs and out pops out a measure of volatility, which we can select a time period for, and here we can see the green line represents VOO's volatility and the blue line represents JEPI, and we can see that volatility was lower for JEPI across the time period measured. And what you're really here for, the dividends. We can see that every month it's paid out a significant yield, although it is interesting to note that it ebbs and flows. So it's consistent in the sense that it gets paid out regularly, but some months it's a little more and some months it's a little less, and this can be explained by how JEPI works under the hood. How does JEPI or any of these ETFs generate this high of a yield? I mean, you can't get a higher dividend yield than what a dividend stock an ETF is holding is paying out, which is typically way less than 7%. So where does the rest of the yield come from? JEPI is a covered call ETF, so it uses its holdings to write options contracts, which lets the fund collect a premium, which will vary based on a number of factors. This is why JEPI's yield is not exactly the same every month. By the way, you and I can do this on our own if we own at least 100 shares of a company's stock, but the benefits of letting a fund manager do this is that we don't have to manage the options trades and we don't have to put up as much capital for the positions. This premium that the fund gets from the options positions is how the fund generates such a high yield, but the downside is that there will be a cap to the upside potential. It's just how covered call options positions work. But remember, the trade-off is the options premium, which makes a high yield ETF possible. The twist for JEPI is that it does this through an agreement with a financial institution. In basic terms, an equity-linked note is an investment where money is lent to a financial institution and then invested in stocks, options, or indexes. The party receiving the money, the institution actually making the trades, can guarantee 100% of the money lent will be returned, which eliminates the downside risk for the lender, in this case the fund manager. The trade-off is that the fund will likely have to give up some upside for the protection of the funds. No such thing as a free lunch, which reduces overall returns, and we as investors will likely not be able to see the exact position since it's operating through an ELN. So that's a very simplified, very basic explanation. There is more to ELNs, but that's generally what most people need to know for the context of this video. JEPI has 129 holdings, and its top holdings include Progressive, Microsoft, Train, Amazon, and a lot of other top companies in the US stock market, which makes sense since this ETF is based on the S&P 500, and JEPI has an expense ratio of 0.35%. Hey, real quick, if you're finding value in this video, be sure to click the like button so that you get more content like this in the future. Now, I like JEPI enough to own it and talk about it with you, but I do recognize that it's just one ETF and there's no such thing as a perfect investment. So for your consideration, our second ETF is JEPQ, also known as the JP Morgan Nasdaq Equity Premium Income ETF. This ETF seeks to generate monthly distributable income and Nasdaq 100 exposure with less volatility, and like JEPI also uses ELNs. So does it do what it has set out to do? This chart says overall the fund has increased by 34% compared to QQQ's 42.66% since JEPQ was first formed. This graph says it's less volatile than QQQ, and this chart shows monthly dividends being paid out regularly. So I would say yes, it has Nasdaq 100 exposure and is less volatile and is distributing monthly income. Quick note here, JEPI has a focus on the S&P 500, or the 500 largest publicly traded US companies by market cap, while JEPQ has a focus on the Nasdaq 100, which focuses on the largest 100 non-financial companies in the US stock market. There is a considerable overlap between the two, but the Nasdaq 100 has a higher concentration of tech stocks, which are more volatile than the broader markets. This volatility makes for some better options contracts premiums, and in the right hands can turn into higher yield. JEPQ has a current dividend yield of 10.02% and has 98 holdings, some of which we all recognize like Microsoft, Nvidia, Apple, and others, as well as some holdings that look a little strange. That's because these are the equity linked notes positions. JEPQ has an expense ratio of 0.35%. Now, I like JEPI and JEPQ, but remember, no such thing as a perfect investment, and where the two of them fall short is tax efficiency, which may be a factor for you depending on the type of investment accounts you're using. Our third ETF solves that problem. This is SPYI, or the NEOS S&P 500 High Income ETF, and it's offering a 12% yield with a monthly distribution, which means investors are getting 1% in dividends every single month. SPYI seeks to distribute high monthly income generating from investing in the constituents of the S&P 500 and implementing a data-driven covered call strategy. But compared to JEPI and JEPQ, this fund takes into consideration tax efficiency. That's because this fund is using a covered call strategy to generate high yields, but it does this using SPX index options, which are classified as Section 1256 contracts, which means they're subject to lower 60/40 tax rates rather than individual stocks in the S&P 500. The fund utilizes a call option strategy that may include both sold and purchased SPX index options, which may provide opportunity for upside capture in rising equity markets. So it's a little more flexible in its option strategy when the market allows for it. Top holdings are Microsoft, Nvidia, Apple, Amazon, and a lot of other large household names, and for comparison, since inception of SPYI on August 30th, 2022, SPY has had a total return of just under 38%, and SPYI's total return has been 25.46%. SPYI has an expense ratio of 0.68%. Now let's get into the details of the dividends. From this chart, we can see an extremely consistent payout, which might raise some red flags, but remember, this is an income-oriented ETF, and the fund managers have decided to distribute the yield in a set amount every month for predictable cash flow. So as long as the fund strategy is making money, it should be able to maintain its dividend payout, and that's one reason why we look at total returns. If you're still here with me, you probably enjoy money, finance, crypto, dividends, all the above, which we talk about on this channel. So consider clicking the subscribe button for more content. Now at this point, you're probably wondering if there's a covered call income ETF that focuses on just the stocks that have large gains in the market and provides enough volatility for great options price action for a covered call trader to capitalize on. The answer is yes, it's FEPI, or the Rex, FANG, an innovation equity premium income ETF. FEPI's objective is capital appreciation and current income. In other words, make money and make money. So it's going to do this by owning large tech companies and writing covered calls on the stocks. And these holdings are all familiar: Nvidia, Micron Technology, Meta, Netflix, and a few others. We get all this for an expense ratio of 0.65%, but that might be worth it considering the massive dividend yield of 25%. And even more impressive is the fact that since inception, FEPI has held up extremely well compared to QQQ. Alright, so our final ETF is actually our second highest yielding ETF on this list, and honestly, it was going to be pretty hard to beat a 25% yield with FEPI. But this ETF is worth mentioning because it's rather unique in how it's structured. And since inception, it's actually beating the S&P 500 in total returns, which is just wild to even think about. It's SVOL, also known as the Simplify Volatility Premium ETF, and it currently has a dividend yield of 15.88%. SVOL seeks to provide investment results before fees and expenses that correspond to approximately 1/5 to 3/5 the inverse of the performance of the CBOE Volatility Index Short-Term Futures Index, while also seeking to mitigate extreme volatility. When I first read that, it made no sense to me, so here's what that means in plain English. The VIX is an index that measures volatility. Investors are able to use a number to help measure the level of fear and uncertainty in the markets. This number is represented by the value of the VIX, which is derived from the price of near expiration date SPX options. So we can interpret a higher VIX as more fear and uncertainty in the markets, and a lower VIX as less fear and uncertainty in the markets. For example, in 2008, we can see a clear spike in volatility due to the housing crisis. So SVOL is trying to reduce volatility as much as possible for the ETF while also trying to track the inverse or opposite performance of the volatility index, or the VIX. It looks like SVOL's current strategy is to anticipate that the VIX or volatility will stay low and short the VIX, which means they take positions that benefit from VIX going lower. As long as there's no spike in volatility and it stays low, the fund makes money. But of course, the fund managers are hedging their bets just in case there is a huge spike in volatility, and they purchase a very far out of the money call option, which means they don't lose a ton of money if volatility spikes up. Think of it like insurance. SVOL has an expense ratio of 1.16%, and it's been paying out a regular dividend similarly to SPYI. That's because the fund managers are prioritizing regular cash flow for investors. So one of the neat things that I found while researching this video was the fact that since inception, SVOL has outperformed the S&P 500, which is impressive given that the S&P 500 is the benchmark for our returns. But if we really dive deeper and look at the total returns of these ETFs since inception of FEPI, the most recently created ETF on this list, we see that there's a clear order of operations. QQQ is in the lead, VOO right after that, followed by JEPI and FEPI neck and neck with everything else, still up over 10%, but significantly less in comparison. And that probably has to do with the fact that tech stocks, specifically AI-related tech, has been booming lately. So all these ETFs are up overall, but covered call ETFs come in a variety of different options and have periods where they will outperform and periods where they will underperform based on the composition and trading strategy. And right now, the market seems to be favoring tech. These are not your typical ETF investments by any means, but they are rather interesting for someone like me who's looking to use them to bump up my dividend yield, and also as an insurance policy against myself, since these positions prevent me from jumping into an options trade that I will probably lose money on because I'm not a good options trader. But I'm not fooling myself. I know that covered call ETFs will capture the downside when markets dip. They also limit the upside when markets rise, and the trade-off is the premium generated from the options position. So these are not for everyone. And of course, the markets are dynamic, and so are these investments. So the values of the positions will change, and so will the yields. On your screen, you'll see my current positions, but you'll also notice that the majority of this portfolio is SCHD. Since I'm a long-term dividend investor, I think this is a good core holding, and you can see some experimental holdings as well with newer, riskier ETFs like Tesla and Coney, and a cash position collecting 5%. So roughly speaking, I should be getting about $58 a month in dividends from the 5 ETFs we went over in the video if nothing changes. Not bad for not lifting a finger. Now, before we go and YOLO into these ETFs, remember there are some other concerns investors should be aware of, like the lack of long-term history for most of these ETFs, the tax implications, the possibility that the dividend and overall value of the positions won't grow as much as other investments, and the fact that dividends might even go down depending on the market. And then there's opportunity cost and the risk of the unknown. No one knows the future. In addition, each ETF has its own individual downsides. Like with SVOL, we don't really know what will happen if a VIX spike occurs, and if FEPI and JEPQ can maintain their yield when tech cools off, and if these positions can keep up meaningfully with the benchmarks ETFs as time goes on. So in short, there's no such thing as a free lunch. There's upside and downside of these ETFs, but I did find that they were good options for me in my current position. Maybe they'll fit somewhere in your portfolio too. We'll all find out together how this whole thing works out. Be sure to let me know what I missed, what I got wrong, and your thoughts on these ETFs in the comment section. And feel free to subscribe and like the video if you found it valuable and are interested in more. Thanks for watching. Have a good one. Good luck in the markets. I'll see you in the next video.